Right now in Canada, if you're self-employed and you walked into your bank to get a mortgage, there's a roughly 4 in 10 chance that they told you no. Even if you're making more money than the salary person sitting across from you at the desk or in line behind you. And the worst part, most self-employed Canadians who get declined don't get told the real reason. They just get a vague "your income doesn't qualify," and then they walk out and assume they need to wait 2 more years, stop writing off expenses, or pay a massive chunk of extra tax just to look good on paper. And that mentality can cost you anywhere from $15,000 to $40,000 in unnecessary taxes for a mortgage you could have qualified for today through different doors. So in this video, I'm going to show you exactly why your bank said no, the 3 specific things they're actually looking at behind the scenes, the workaround that 90% of bankers don't explain properly, and at the very end, a bonus tactic specifically for incorporated business owners that can unlock 30 to 40% more borrowing power without changing what you pay yourself. So let's get into this. Here's the rules of the video. We're not doing rate predictions and we're not bashing the banks. They're just doing what their systems tell them to do. Okay, maybe we'll bash them a little bit, but we're going to be looking at the hard math. What lenders actually see when your file lands on their desk, and then map out the exact escape path. By the end, you'll know which lender type fits your situation, what documents to gather up, and what not to do in the next 90 days before you apply. Let's start with the macro context, because this is where most self-employed Canadians get blindsided. The big 6 banks being RBC, TD, Scotia, BMO, CIBC, you know the rest. They are called the A lenders, even though technically speaking, I would say they're B lenders in comparison to our monoline lenders who have better products. And the thing with these A lenders qualifying you using one number is it can create issues. The number they use is called the line 150, so your net income on your T1 general. And they do a 2-year average. That's it. That's the box. Check it or don't. Now, think about what self-employment actually is. You spend your entire year doing exactly what your accountant tells you to do, saving receipts, writing off your vehicle, home office expenses, your phone, your meals, your software, your subcontractors. You legally and intelligently bring your taxable income down so you keep more of your money. And then you walk into the bank and the exact same accountant-approved strategy that saved you, let's say, $20,000 in taxes is the reason the bank thinks you can't afford a $500,000 mortgage. And that's the trap. The Canadian tax system rewards you for writing things off, but the Canadian mortgage and banking system punishes you for it. And nobody, not your bank rep, not the CRA, not your accountant, connects those dots for you until it's too late. All right, this is where I'm going to give you something that most people don't really see or talk about. There are 3 specific places self-employed files actually die at the bank. Once you know them, you can plan around all 3. The first one being the 2-year average rule. Banks take the average of your last 2 years of net income. So if 2024 was an absolute banger of a year and 2023 was, let's say, rebuilding or a slower year, they don't see the trajectory. They see the average. One bad year drags down a great year, and you qualify for less than you currently could based on cash flow. The other thing they look at is, let's say 2023 was a great year and 2024 kind of sucked. In that case, you run the risk of them using the lower of the 2 because they structure it as the 2-year average or the lower of the 2 in some situations. The second struggle is add backs most lenders won't apply. Things like capital cost allowance depreciation, business use of home, and certain one-time expenses are technically supported to be added back to your qualifying income. Most A-lender bank reps won't do it. Either they don't know how, or their underwriting systems make it too painful for them to do. So your real economic income gets buried under paperwork and monotony, where if it wasn't, you could qualify for more. And the third struggle is the documentation gauntlet. 2 years T1s, 2 years notices of assessment, business financials, proof CRA is paid in full, GST and HST up to date, sometimes T2s for your corporation or articles of incorporation, and sometimes even contracts. Miss one document, your file sits. If it sits too long, your rate hold expires. That's how qualified deals fall apart, and why at our office we do all of our underwriting up front. We get the documents in, we get everything we need before we even think about talking about interest rates. I'd hate to give you a rate and get your rate hold and then end up losing it because we don't have a certain document. Just doesn't make sense. Do the legwork up front so you can save yourself pain later on down the road. Now, here's where it gets interesting. Because the bank's front door is one option, there's actually 3 other doors specifically built for self-employed Canadians. Let's look at the hard data on each of those. Door 1 is the CMHC Self-Employed Program. If you've been self-employed for less than 2 years, or your reported income looks low because of write-offs, CMHC has a specific insured program that lets the lender use stated income based on what your business reasonably should be earning given your industry, your time in the business, and your bank deposits. You can get into a home with as little as 5% down at A lender rates or best possible rates, and most bank reps don't even mention this option exists. Door number 2 is alternative and B lending. Lenders like Equitable, Home Trust, and a handful of credit unions specialize in self-employed files. They use bank statement programs, typically 6 to 12 months of business deposits, to calculate your income. The trade-off? The rate is usually about 0.75% or 1.5% higher than a traditional A-lender product, and you'll need 20% down for them to be able to proceed. But you keep all of your write-offs, you qualify for what you actually earn, and you can refinance back to better lender rates if it makes sense in the future to claim a higher income after 1 to 2 years as the tax returns play catch-up. Now, in these scenarios, I've run these mortgages time and time again where people are incorporated and they'd rather keep their money in their corporation and pay less tax and pay a higher interest rate and maybe even a lender fee because the amount that they're saving on taxes is more than that fee and more than that higher interest rate will cost them. It's all dependent on your situation and what you're looking to do. Now, door 3 is one that we try to avoid, but it's there if you need it, and that's private lending or creating a bridge loan strategy. Short-term private money comes with higher rates, a 1-year term, interest-only payments, and this is not a live here forever kind of product. It's a bridge. You use it to close on the property now, fix whatever's broken on your file over the next 12 months, then refinance out into better options. When used correctly, it's a tool. Used incorrectly, and it's a very expensive trap. So if anyone's promoting a private mortgage to you and they don't have an exit strategy, or they haven't talked or planned an exit strategy for you to get out of it, you may want to talk to someone else. Now, you might be thinking about this, Myles, this sounds great in theory, but does it actually work? Well, let me show you the exact math. Let's say there's a self-employed contractor with 2 years of T1s. 2024, line 150 was $58,000. 2023 was $52,000. That gives a 2-year average of $55,000. With current stress test rates, that qualifies them for about $285,000 of mortgage funds at the bank. Not enough to buy really anywhere in Canada. But here's what the file actually looks like underneath. Gross business revenue, $172,000. Add back the CCA of $9,400. Add back business use of home, $6,200. Add back the personal portion of the vehicle expense the accountant aggressively wrote off, around $4,000. Real sustainable economic income closer to $95,000 to $105,000. Through a B lender or bank statement program, that same person qualifies for roughly $480,000 to $510,000 in mortgage funds. That's almost double the borrowing power. The interest costs over the first term is higher, about $180 to $240 a month in extra interest over a $500,000 mortgage. But the alternative was not buying at all or paying an extra $20,000 extra in tax for 2 years to make sure you can fit in the bank's nice little square box they like to fit you in. The one thing you have to remember about all this is math doesn't care about headlines. Math doesn't care about which lender logo is on the door. The math just wants to know what you actually earn and what you can actually afford to pay back. And finding a lender that uses that math can be the difference between getting an approval back and buying a house or not. All right, this last part is for the incorporated business owners specifically. So if you're incorporated, great. If you're thinking about it, stick around. It's going to be a bit of good information for you. Most incorporated owners pay themselves one of 2 ways, salary or dividends. Salary qualifies cleanly at the bank. It shows up on your T4s. It's super simple. Dividends can be a bit messier. Most A lenders will only count them if they've been taken consistently over the last 2 years, and even then, they often discount them or don't use all of it. Here's the move. With the right lender, you can qualify on a combination of 1, your T4's salary or dividends, whichever you've drawn out personally, 2, plus retained earnings inside the corporation, the profit you left in your company on purpose for tax efficiency. And 3, minus what's needed to keep the business operating. Translated, that pile of cash you intelligently left inside your corp to defer your personal taxes, with the right lender, it becomes a qualifying income. I've seen this single tactic move someone from a $400,000 approval to a $620,000 approval. Same income, same business, same tax return, just a different lender that knows how to read the T2 properly. If you are incorporated and your bank told you no, there's a very strong chance they were just looking at the wrong numbers. And if this puts you into the waiting game, well, that just generally hurts you because you probably could have qualified before. Self-employment is not a disqualifier in Canada. The wrong lender for your situation, that's the problem. If you want help mapping out your specific income, business structure, or corporation, there's links in the description below where you can book a call with me and my team and we can run the numbers and see how it would work with mortgage qualifying and financing. There's no pressure here, it's just clarity. We'll tell you which of the 4 doors actually fits your file before you spend time running from bank to bank, getting your credit bureau pulled, pulling all your documents and things like that. You bring stuff into us once, we look at all the lenders for you, and it's done. My name is Myles Nowik, owner of the Nowik Mortgage Team powered by Andy Mortgage. I've been doing mortgages for over 15 years, and our company's been doing it for over 36, with over $2 billion in mortgages funded. And if you want help with your mortgage, as mentioned, there's a link in the description below. And if you got value out of this video, maybe hit that like and subscribe button so more people like you can see it. And if you want to know why this market feels a little bit frozen when it comes to real estate and listings, click this video right over here. We'll catch you on the next one.